Welcome to vTalkInsight, Market Drivers Daily for April 21st, 2026. Oil is flirting with triple digits. Iran's ceasefire clock is ticking, and the Federal Reserve is being pulled into the artificial intelligence narrative. Cross-asset pricing is being redrawn in real time as energy, tech, and rates collide. Let us begin in the Gulf, where tensions around the Strait of Hormuz continue to anchor the global risk backdrop. Gulf tensions around Iran and the Strait of Hormuz remain the key macro swing factor, even as headline equity indices and credit spreads still look surprisingly calm. An effective United States naval blockade and recent strikes have severely degraded Iran's air and naval capabilities, giving Washington leverage but also locking in a persistent risk premium for energy and shipping. Over recent days, tanker flows through the strait have slumped from more than a dozen vessels a day to just 2 or 3, and many ships have stopped broadcasting locations altogether. That combination signals both physical disruption and heightened uncertainty about how long the choke point will remain constrained. The political calendar is tight. The current United States-Iran ceasefire has been extended only briefly, with Wednesday flagged as a key expiry point and no firm commitment from Tehran to attend talks in Islamabad. Iranian officials insist they will not negotiate under threat while the blockade is in place, while Washington has hinted at renewed strikes, including on infrastructure, if there is no concrete progress within days. That raises the probability of a narrow, face-saving deal focused solely on keeping the strait open, rather than a broader nuclear settlement. Oil markets are already reflecting strain. Brent is hovering in the mid-$90 per barrel area and has briefly traded above 100, while West Texas Intermediate has jumped more than 4% on renewed escalation headlines. Spot prices now sit well above futures, pointing to an emerging physical shortage. European jet fuel inventories are at 6-year lows, with some analysts warning supplies could be exhausted within weeks if Hormuz remains constrained, and airlines are feeling it first. Alaska Air has withdrawn profit guidance and flagged a $600 million increase in its fuel bill. United Airlines has cut its earnings outlook, and European carriers such as Lufthansa are canceling thousands of flights. That mix of higher costs and capacity cuts is pushing sector-specific credit stress higher and raises the risk of demand destruction later in the year. Beneath the surface, the macro hit is broadening. Top oil traders report global demand has already fallen by around 4 million barrels per day because of the war, with a 5 million barrel drop, and even a global recession flagged as a risk if strait disruptions persist. Higher fuel costs are squeezing households, with lower-income consumers citing gasoline as a major burden and discretionary spending likely to feel the impact over the next 3 quarters. Europe and lower-income Asian economies, already wrestling with energy and immigration challenges, look particularly exposed, while commodity exporters in the United States and Latin America appear more insulated. Long-dated government bond yields may stay elevated as governments respond with larger defense budgets and energy support, widening fiscal deficits. At the equity level, defensive sectors such as healthcare and utilities are seen as relatively less exposed to this combination of geopolitical risk and higher rates. Yet market pricing still leans toward a contained outcome. Major equity indices have been resilient, credit spreads have tightened back toward pre-war levels, and energy stocks have actually underperformed in April despite rising geopolitical risk. Oil-time spreads suggest traders expect partial de-escalation, with some base cases keeping Brent near $80 by year-end if the strait gradually reopens. Supply chains are adapting via alternative sourcing from regions like Texas, Louisiana, and Alaska, and China's earlier inventory build gives it a temporary buffer. The key watch points now are whether the ceasefire is extended again this week, whether United States and Iranian delegations actually meet in Islamabad, and how quickly the backlog of roughly 800 stranded vessels clears. Airline guidance revisions, defense earnings, and real-time jet fuel data will show how far the shock has migrated from energy into growth and credit. Against that backdrop, attention is gravitating toward the one equity theme many see as relatively insulated from oil shocks: artificial intelligence. Artificial intelligence remains the primary growth engine and narrative anchor for risk assets. Robust demand for infrastructure and early-stage enterprise deployments is supporting constructive earnings paths, and the theme is widely perceived as less sensitive to the current energy shock. Analysts see revenue growth of around 9% and earnings growth near 17% for the S&P 500 this year and into early next year, with strong consumer demand reinforced by ongoing AI infrastructure spending. That combination underpins why tech-heavy indices continue to trade near record highs despite geopolitical noise. Capital is rapidly rotating toward AI picks and shovels. Within tech hardware, spending is moving away from traditional cloud builds and into AI-focused servers, networking, and power systems. Amazon's deepening partnership with Anthropic is emblematic, a $5 billion investment with the option to add up to $20 billion more, alongside Anthropic's plan to spend over $100 billion on Amazon Cloud and AI chips over the next decade. That commitment has already lifted Amazon shares in pre-market trading and signals sustained demand for compute, storage, and energy. Semiconductor and memory names are benefiting as well. Companies such as Micron, ASML, STMicro, and Infineon are seeing earnings upgrades on the view that structural AI-driven demand could reduce cyclicality and support stronger pricing power, even though near-term memory chip shortages remain a key bottleneck. The AI boom is not costless for capital markets. Estimates suggest roughly $630 billion of new AI-related financing needs over just 6 months, raising questions about how easily credit markets can absorb supply, even from high-quality issuers. At the equity level, investors remain optimistic on large technology names as long-term holdings, but are increasingly skeptical that every major platform can justify current valuations. Positioning has become more selective, with a tilt toward infrastructure, power, and memory providers, and some preference for AI-linked utilities and digital infrastructure financing over richly valued software stories. Private market investors are also focusing on middle-market opportunities in data centers and power control systems as a way to gain AI exposure without paying public market multiples. All of this interacts with the rate backdrop, because an AI-driven productivity boom is expected to raise demand for capital and may put upward pressure on interest rates rather than paving the way for quick cuts. Corporate strategy choices around AI are becoming more consequential. Apple's leadership transition to John Ternus, a hardware-focused executive, comes as the company faces criticism for a cautious, capital-light approach to AI and heavy reliance on iPhone sales. Apple has prioritized partnerships, including integrating Google's Gemini models into a forthcoming Siri upgrade, rather than building its own large language models at scale. Supporters see this as a way to leverage premium hardware while avoiding massive capital expenditure, but critics warn it could leave Apple exposed if competitors move faster in agentic AI and software-driven experiences. Cyber risk is another emerging fault line. Anthropic's Mythos cybersecurity model has reportedly been accessed by unauthorized users, highlighting the risk of intellectual property leakage and the potential misuse of powerful AI tools. That breach coincides with growing enterprise demand for AI-driven cybersecurity, where firms want customized models to address sector-specific threats, and with a broader recognition that groupthink and reluctance to issue negative ratings may be distorting perceptions of AI's true risk-reward profile. The counterpoint to today's optimism is that the monetization timeline remains uncertain. A key risk flagged by several observers is that if major hyperscalers fail to show convincing returns on AI investment by mid-2025, they could throttle back spending, triggering an abrupt correction in AI-exposed equities and a drag on growth. Highly levered tech companies with large capital expenditure programs may be particularly vulnerable, echoing past episodes in the telecom sector. There is also skepticism about using AI's long-run deflationary potential as immediate justification for easier monetary policy, given limited hard evidence of near-term productivity gains. Key watch points now include big tech earnings and capex guidance, memory and power capacity additions, the pace of AI-linked bond issuance, and any regulatory response to model breaches. Those signals will shape whether AI continues to justify its current premium and how central banks, including the Federal Reserve, incorporate productivity narratives into their rate decisions. The interest rate story has shifted decisively away from imminent cuts toward a higher for longer backdrop. Market participants now expect, at most, a single quarter-point Federal Reserve cut by year-end, and many see even that as contingent on softer data. Two-year Treasury yields are anchored close to the Fed funds rate, while the 10-year remains around 4.25%, reflecting skepticism that policy will ease quickly in the face of strong growth, elevated oil prices, and persistent inflation. Kevin Warsh's confirmation hearing has become a focal point for this repricing. In his testimony, he emphasized that inflation is ultimately a policy choice, criticized errors made in 2021 and 2022, and underscored the Fed's responsibility for price stability. Warsh signaled a preference for using interest rates rather than the balance sheet as the primary policy tool, arguing that rate moves are fairer and less skewed toward asset holders. He also advocated gradually shrinking the Fed's balance sheet and even floated a return to a scarce reserves framework, a shift that could have significant implications for repo markets and short-term funding liquidity. At the same time, he stressed operational independence and downplayed political pressure for immediate cuts, echoing broader FOMC signals that June easing is highly unlikely despite external noise. Incoming data strengthen the case for patience. Retail sales and other activity indicators have repeatedly surprised to the upside, with upward revisions to prior months underscoring that the United States economy is absorbing the oil shock better than many expected. Persistent inflation above the 2% target is now projected for a fifth consecutive year, and higher energy prices linked to the Iran conflict add another layer of uncertainty. Against that backdrop, bond markets appear caught between inflation surprises and familiar Fed communication, leading to a sense of paralysis in fixed income positioning. There is also concern that aggressive front-end Treasury issuance, combined with delayed Fed easing, could trigger a bear steepening of the yield curve, weighing on equity valuations and commercial real estate, even if policy rates do not rise further. Policymakers are increasingly debating how AI-driven productivity interacts with this higher-for-longer stance. Some expect future Fed communication to lean on AI as a disinflationary force, potentially justifying rate cuts in 2025 even if headline inflation progress is only gradual. Warsh himself has signaled openness to lower rates over time if credible evidence emerges that AI is boosting productivity and holding down prices. However, others are skeptical, arguing that using still nascent productivity gains as a rationale for early easing risks unanchoring inflation expectations, especially while energy remains a source of upside risk. The Fed is also signaling that balance sheet support in future episodes of market stress may be more limited than in the past, which could leave risk assets more exposed to volatility during any policy transition. Looking ahead, several markers will shape the rate path narrative. Progress on Warsh's confirmation and the Department of Justice investigation into current leadership will inform, but not immediately change, the committee's stance, which remains focused on inflation control. Key data points include upcoming inflation releases, retail sales, and any evidence that higher oil prices are meaningfully weakening consumer spending beyond gasoline. On the market side, the behavior of 2- and 10-year yields, the slope of the curve, and demand for rate hedge products will signal whether investors buy into the higher-for-longer message or continue to price earlier easing. At the same time, watch for how AI-related capital expenditure, credit issuance, and productivity data are framed in Fed communication. Together with the evolving energy shock and geopolitical backdrop, Those factors will determine whether today's resilient risk appetite can coexist with a more restrictive and potentially more volatile monetary regime. To sum up, Gulf tensions and the Strait of Hormuz remain the central macro swing factor, keeping a risk premium in oil and jet fuel and pressuring airlines, energy importers and fiscal positions, even as equities and credit still price a relatively contained outcome. At the same time, AI infrastructure and enterprise deployment continue to anchor the growth story, with capital and earnings gravitating toward picks and shovels hardware, power and cybersecurity, but with rising scrutiny on financing needs, monetization timelines, and operational risks. Over all of this sits a Federal Reserve that is signaling higher for longer, with Kevin Warsh's testimony reinforcing the focus on inflation control, balance sheet normalization, and policy independence, even as AI-driven productivity narratives begin to influence the longer-term debate on rates. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.